Hello, everyone, and welcome to the Sustainable Finance Podcast. My name is Paul Ellis, and I'm your host for these programs about developments in this fast-growing industry. Paul Hailey is head of Impact and ESG at responsAbility Investments AG, which specializes in private market investments in emerging economies across three investment themes. These themes of financial inclusion, climate finance, and sustainable food contribute directly to the United Nations Sustainable Development Goals. They finance the growth of microcaps, small to medium-sized enterprises, and contribute to a net zero pathway and sustainably feeding an ever-growing population. All responsAbility investment solutions target specific, measurable impact alongside market returns. Since its inception in 2003, responsAbility has deployed over $15 billion in US dollars in impact investments and currently manages US $5 billion in assets. Hello, Paul, and welcome to the Sustainable Finance Podcast.
Hi, Paul. Thank you. It's a pleasure to be here.
Yes, we're excited to have you on the program today, and we're going to jump right into the questions if you're ready. And the first one is,
fire away.
What has been the impact of regulations such as the EU's Sustainable Finance Disclosure Regulation, SFDR, in the emerging markets so far?
Well, thank you, Paul. And first of all, as I said, thank you for having me on the podcast. I appreciate that there's probably going to be some people out there who probably think that the topic of regulation is not necessarily the most enthralling topic to pick up, but it's one that's it's very far-reaching, right?
It is, and it's very real for everyone in the next couple of years, at least, right?
I think what's quite important, I would compare it a little bit to some of the regulation that's been passed, for example, in the US in the past, which specifically said, look, if you commit certain misdeeds abroad, even if you're not American, even if you're not doing an American company, it's within our jurisdiction. Now, the thing about SFDR that makes it wide-ranging is, look, if you want to market your product in the EU, then you have to abide by those rules, basically, even if you're not based in the EU yourself. So one of the things that's been quite striking for me is the number of times I've been talking to other investors, my counterparties, head of sustainability in an American asset manager or a British asset manager, and they've been saying, well, look, we're not in the EU, but this has a direct impact on us, kind of thing. So it is very far-reaching as regulations go. In general, the SFDR isn't a huge conceptual leap for us because basically it's effectively built, or rather their definition of what is sustainable is built on three key building blocks, right? So number one is that you've got to show that the investment makes a sustainable contribution. In other words, it's positive impact. There's got to be an impact thesis of some sort behind it. Well, fine. For us, that was baked in. We're a specialist impact investor. Of course, we're going to have that. The other two elements are do no significant harm and good governance, which is all of which is to say, look, you have to check that your investments are not doing anything bad in terms of environmental, social, or governance to their staff, to their customers, to the broader community, to the environment. Again, if you're already in this space, that's kind of assumed that this is what you're going to do. So on that level, it wasn't a big stretch for us. And I know you would say, well, that should be true of any sustainable product out there, but I think it's fair to say that certainly a few years ago, there were still quite a few quote unquote ESG products that were just based on exclusions that said, look, we filter out the worst and then, carry on with the rest. The regulation has forced a bit of a conceptual shift in that respect. So on that level, it was okay for us, right? What it has meant for us and for everyone is, of course, a lot more disclosures. You have to really think about, you have disclosures on your website and your prospectus and your annual report and everything else. Fine, but we all have to live with that. What I think is tricky, though, nonetheless, is that this is a regulation that, in some respects, we feel on a conceptual and a practical level, is, however, nonetheless very much focused on where the bulk of sustainable assets are in the EU, which is to say listed assets in the EU. It's not really as well designed for products like ours, I would say.
Okay. So what I think I hear you saying, Paul, is that SFDR is, as you just said, not specially designed for investments made by your firm.
Yes.
And can you expand on that a little bit? Are there other issues related to SFDR that your firm does have to work with outside of the overall reporting?
Sure. Well, look, I think all right, let me address one point. I think the
Sure.
first thing, just as a general statement, I should say, is obviously um, the idea of having a regulation around non-financial disclosures around sustainability is obviously not bad per se. If you think about why do we have regulations of any sort, it's to ensure that there is market confidence. And for the last few years, we, like many other specialist impact investors, have been saying, look, there is a bit of a risk here that if you get more and more of mainstream actors piling into this space, there is a risk that people lose confidence, full stop, in sustainability and ESG, in the idea that fundamentally a financial product can have a positive impact. So it's, we've all seen what happens when there's a failure of regulation, be it 2008, be it 1929, pick your year, basically. So we're all aware what the consequences can be. And similarly, the risk of something like that happening on sustainability side would be obviously very problematic, not least for the likes of us, that we might get lumped in with others. So it makes sense to have that. I think, though, there are some issues with the regulation in terms of both how it's been implemented and also there are maybe some fundamental issues with it. One of the more fundamental topics, I would say, fundamental issues with it, is that there's not much differentiation made for the differing requirements and contexts of a developing market versus versus the European Union. So if we take climate as a topic now, one thing that you're meant to look at in your in SFDR, one of the principal adverse impact indicators that you're meant to look at under your DNSH analysis is what are the emissions of an investment? What's its carbon footprint? What's its GHG intensity? Which is fine, and that's logical. The problem is, though, that it effectively treats everyone on the same line. So it's effectively saying that if you are a microfinance institution dealing with smallholder farmers in India, or dealing with someone who runs a market stall in Vietnam, you should be treated on the same level, and your emissions are exactly in the same context, well, or lack thereof, compared to a big European corporation. Now, this is problematic for a couple of reasons. One is that there is clearly a much bigger need for development, economic development in many developing markets, because that is how sustainable development occurs. So that implies a certain degree of emissions, but from a very low base, and with a view to improving social outcomes as well. The same is not true of a European company. So I think that's one topic. The second topic is, of course, that it doesn't take into account the fact that emissions are, of course, damaging on a cumulative level, and the vast majority of emissions emitted up until now have been emitted by the developed world. So to put, as I said, an agricultural cooperative in Ivory Coast on the same level as, Tesla, that's clearly not fair. It's clearly not the right way to go about things. And it also, I would say, contradicts to a certain extent many of the development objectives that the EU has set out elsewhere. So that's the conceptual element. There are also practical elements. I don't want to bore you with the details, but of course, you have to collect quite a lot of data for this.
Mm-hmm. Mm-hmm.
Those data reporting requirements, again, are far harder for smaller companies in the developing world to carry out than other larger corporations in Europe. And there are also some quirks of the whole thing which don't make an awful lot of sense. For example, the fact that cash is automatically considered to be a not sustainable investment that has to be taken into account. Well, that's fine, because if you're a listed product, cash management is a very easy thing to do. You dip in and out of the market, that's fine. If, though, you're dealing with private debt or private equity, and in our space, to reach the countries where we are going, where there are no or very little in the way of functioning capital markets, the time to deployment is much longer. To put it bluntly, if we want to make a climate smart agricultural investment, doing something that's really meaningful, really has an impact, really affects, and intervenes and helps a company to improve agricultural practices in the developing world, it's clearly going to take a lot longer than if you click on a button and buy 100 shares of Google. So, okay. And again, the regulation doesn't take that into account.
Okay, we're talking about sort of the big picture and the entire market concept in some ways. And if it's okay with you, I'm going to play devil's advocate here and ask, why should we really care as advisors, as investors, as financial consumers, since everyone investing in the EU economies has to live with the SFDR regulatory burden. No one's exempt. Am I correct about that?
I mean, any product that wants to market itself as sustainable
Mhm.
has to live by those rules and has to play by those rules. So it's true that, look, we all have to operate on that level. I would argue, as I counteract your devil's advocate,
Okay.
I would argue that there are two reasons that say why we should care. One on a moral level and one on a practical level. Now, on the moral level, well, perhaps not even on the moral level. This is also a different kind of practical. The idea behind this regulation is, yes, to ensure there's market confidence, but why do we want sustainable products in the first place? Well, that is part of the EU's action plan on sustainable finance. What they are trying to do also is mobilize finance towards addressing some of the big environmental and social problems of our age. So that's also the fundamental driving objective. And this is part of, there's many other parts of this as well. There's various reporting requirements on corporates in EU as well at a corporate level in terms of their sustainability disclosures. There's going to be something around creating a certification. There's a lot of different elements to this, but fundamentally we're all pointing towards the same thing. How do we deal with the big environmental and social problems of our age? Now, as I've said before, this is great, and I'm all in favor of it. The problem that you might have, though, well, what I would argue, but perhaps I'm a little bit biased, is that a lot of those problems are particularly acute, and the challenge is in a big proportion of the problem lies within the developing world, especially if you look on the social side. Now, on the environmental side, it's certainly true in the sense that, as I've said, we know that if we're going to address some of the social concerns that we have, that's going to necessitate a rise in emissions. So we also have an obligation to try and invest in energy infrastructure, for example, to try and ensure that the transition, that when they increase the capacity installed in developing countries, it's done using renewables and not coal, just to give you one example. So we know that we have to address that because 1 ton of emissions there is the same as 1 ton of emissions here, and in that respect. So that's one element. On a social level, much as there is plenty of deprivation, very unfortunately, in the developed world, the extent and the depth of many issues on the social side in the developing world is much bigger. There are many topics that are set out clearly by the SDGs that are overwhelmingly developing world problems. Lack of access to finance, to pick one example, lack of access to clean water, lack of access to electricity. Now, the private sector can't solve all of these, but there are plenty of these topics, and I think particularly two topics that we deal with that I've just listed out of the ones there, access to electricity and access to finance, where basically there isn't enough money from the public sector to address these by itself. We have to get the private sector to invest there. And we have to do it in countries where, as I've said, there's no capital markets involved and where they currently represent a very small proportion of overall flows within the financial sector. So ultimately, a regulation that really pushes money in this direction is, I think, a critical part of us meeting any of the objectives we set ourselves. But a regulation that gets in the way of that risks exacerbating problems that are already in place.
So we're talking about blended finance now, right? When you start getting the
sorry,
public,
I should have nodded to that as well.
That's okay.
I failed to mention that. Thank you for picking me up on it.
Yeah, no problem, because that's where I want to go next. I know that the UN and a lot of other NGOs focus on blended finance as a concept that they're using, but you've been using it for many years, right? And tell our followers why it's important and what it actually does in terms of blending the way that you address the capital requirements in these developing markets.
Sure. Well, look, blended finance tends to be less something that where NGOs are involved and more something where the different development agencies of countries are involved.
Okay.
So blended finance is by definition a mixture of money from private investors and also public investors, be it, for example, IFC, the investment arm of the World Bank, be it DFC, for example, which is the American Development Finance Institution, or the KfW, FMO, BII, this kind of alphabety spaghetti of acronyms everywhere. But basically, there's a lot of different most of the developed world countries have their own development finance institution, and they use blended finance. And why do they use blended finance? Why don't they just go out there and invest themselves without bringing in private investors? And the answer is that in many cases, they partly as a demonstration effect. So they want to try and encourage private investors to invest in developing countries in sustainable topics. But also because in some instances, they are able to catalyze a much bigger amount of investment than the amount that they've initially put in. Sometimes this is because they will accept a lower return versus the level of risk they're taking. But then if the flip side of that is, okay, they invest 20 million into a fund, but then that allows them to bring in 60 million from private investors who otherwise might have found the overall risk return balance not in keeping with their risk perceptions, then for them it's a net gain, obviously. They've accepted the slightly lower return. But in exchange for that, they've mobilized a much larger amount of money. Now, it's not all blended finance is done on that concessional basis, but that's kind of the classic example. So ultimately, this is quite a central plank of many countries' development objectives and many of the development finance institutions' objectives. They are trying to move in this direction because it enables them to achieve a lot of their objectives with, relatively speaking, a smaller amount of investment.
Okay. Now, can you share some success stories or impacts generated through your latest blended finance funds that are focused on sustainable food and climate finance? No names, but
no names.
Give us a couple of examples.
No, well, if I'm doing a whole thing on regulation, it would be remiss of me to then start naming products, wouldn't it? Okay, so one example would be there was one fund that we launched relatively recently that was very much focusing on agriculture with a climate smart lens. So really focusing on making long-term investments in agricultural organizations in the developing world with a view to putting in place practices that would reduce their emissions, increase their productivity, reduce water consumption, topics like that are essential for helping to mitigate climate change and also adapt to climate change. Now, agriculture is a sector that's very vulnerable to the effects of climate change. It is also a sector that, needless to say, is also contributing to a certain extent to climate change as well. It represents anything between 25 and 33% of global GHG emissions. So it's clearly a target sector. And the developing world represents this very significant chunk of overall agricultural output. So it's a bit of a no-brainer, really, to say, well, of course, you have to invest in this space. Problem is, though, again, if you're looking at mid-sized companies in, say, Africa or Latin America, and you're talking about an investment horizon of maybe 4, 5, even 7 years, there are relatively few investors that are actually willing to dive into that space. So having investment from development finance institutions as part of that's useful in many respects. A, it reassures any investor, look, clearly we're going to be subject to very high standards around impact and ESG. Now, we have our own track record, of course, but if we're able to say, well, look, these DFIs have done a very extensive due diligence on our processes and practices, that's going to reassure investors on that side. On another level, the fact that you've got DFIs that are willing to commit long-term funding to that kind of product, that also reassures investors. Another example might be we have issued a couple of bonds recently, where again, the underlying portfolio from which this bond was issued was a portfolio of, in one case, microfinance institutions, loans that we'd made to microfinance institutions. In another case, it was a mixture of microfinance institutions and organizations from other sectors, health, water and sanitation, agriculture, etc. And in both instances, we had development finance institutions that were coming in and providing either guarantees or taking a reduced rate of return in order to try and catalyze private investment. Now, that's a new structure. it's relatively, I would give ourselves a pat on the back here and say it's quite innovative even in our space. But ultimately, it was a structure that we feel catalyzed a lot of investment into that space. And from the perspective of the DFIs, it's a success for them as well. They get to say that they've mobilized all of this money, and it's something that we think was quite effective.
Okay, so the benefits of development finance in this type of infrastructure are very strong based on what you've just told us, and that's when regulation is done right. From your perspective and from your firm's experience over the last 2 decades or so. But what if the regulatory aspect of development finance is done wrong? That can probably have a significant negative impact in the developing markets especially. So just tell us why it's so important for development finance to be well coordinated between these large global agencies and firms like yours.
Well, look, I would say, as you said, we've been going for 20 odd years. It is a long time that we've been in place. I think from the SFDR and these regulations are a relatively recent occurrence. It's only been a couple of years, much as it feels much longer to me at times. So I think we're still waiting to see what the long-term effects of this are. And it's also worth pointing out that the regulatory landscape is shifting very dramatically. It's not just the EU that's introduced this. The UK has just introduced the SDR, for example, which is its equivalent of that. There is presumably other such regulations on the way from say, Switzerland, for example. So it's inevitable, I think, that the regulation will take more twists and turns. You'll see other ones coming in. There is also a risk, I guess, that if you have, given that many financial products are sold in multiple jurisdictions, that we might end up with a situation where you have a product that can't satisfy simultaneously the demands of, say, the UK and the EU. So that's one general risk that you have there. That said, I do have a lot of sympathy for regulators and for policymakers around this. It's not easy to try and come up with cross-cutting regulation that covers something that's very wide-ranging, like sustainability, impact, ESG. You're certainly never going to please everyone all of the time. That's inevitable. In fact, one might argue that if you have a regulation where everyone's delighted with it, that's probably a sign that it's not actually working. But maybe I'm being a bit cynical there. I also think that it's logical from the perspective of the regulators to look in the direction of where the bulk of the assets are, because they're going to be thinking to themselves, look, their primary obligation as a regulator is to protect consumers. So they will be thinking, okay, what are the vast majority of products out there? What should we look at? And it's going to be, as I said, listed products investing in the EU. So for them, they're going to say, well, of course, they're going to look at that and they're going to say, well, I'm going to really pay attention to that. Incidentally, I also have a huge admiration for the fact that some of the regulators have had to become overnight experts in sustainability. How they've managed that from a staffing perspective, I honestly don't know. And here's the thing. Of course, regulators don't actually write regulation. They're there to implement it. They're there to apply it. Policymakers write regulation and legislation, right? And policymakers have a duty to set their horizons more broadly, broader than that. And in the case of policymakers, as I've said, these regulations are part of a broader attempt to really catalyze investment into addressing some of the big environmental and social challenges of our age. And these are huge challenges, huge challenges. If we can address, we all know what the consequences of not addressing climate change will be. Although I think sometimes we could do with reminding ourselves there are potentially massive risks from us not dealing with this, not just in terms of the human cost and the environmental cost, but also economic cost as well. It's going to cost vast amounts of money if we don't address this topic. On a social level, as I've said before, there are very significant pressures out there. There are still hundreds of millions of people in 2024 in the world who don't have access to electricity. There are still hundreds of millions of people out there who don't have access to a bank account. These are colossal problems and they are urgent and they're now. They are problems that are for now, and we have to address them. So it's absolutely critical that we find regulation that actually enables the flow of money into this space and that really addresses this. And if we have a regulation that does the opposite of that, well, then that's a huge problem. So really, I would say it's important for policymakers, or if policymakers can't, for whatever reason, do this, it's important for regulators to take a step back and think, well, look, let's look at where most products are and where the bulk of sustainable assets are. Sorry, that was a sarcastic air quotes. It's very unfair. There's plenty of sustainable listed products out there. But let's also look at where the need is as well. And let's try and encourage and foster the growth of products in that space.
Okay. Now, I was just at a conference last week where a lot of the people that I talked to and interviewed were feeling better about the way action is being taken in sustainable finance. So very quickly, do you have any thoughts on that from your perspective in Europe? This conference was in New York, and there were people there from all over, but it seemed like there was a positive focus on the way people and organizations and funders are acting and thinking about the whole process right now. How do you feel about that, and how are the situations that you're focusing on affected by an improved outlook?
Well, it depends why they're feeling optimistic. Are we addressing some of the topics of our age? Well,
Okay.
we know we're still falling short on a lot of the things that we have to try and address, right?
Right.
So on that level, we know that there's a huge amount of work to do. Do I feel optimistic about a general increase in awareness around this topic? Yes, I do think that generally, if I can take a very crude proxy, which is what our investors are asking us now and the sophistication of the questions that they are asking around the sustainability topic. I find that now there is, frankly speaking, I'm getting much tougher questions from the average investor. When I go to a conference, when in terms of the surveys that we receive, in terms of when we are subject to a due diligence, when I look at the number of times now that I am being interviewed over this by a sustainability professional, as opposed to, say, a portfolio manager who has this, as an additional part of their responsibilities. So I think now in general, investors are much more aware of this topic. And I think the end investor is much more familiar with this topic. I also think there's a generational element as well, as we see the passing of different, of wealth from one generation to the next, from the baby boomers to the, to the Gen X, to the millennials. Clearly, that's going to have an influence. Clearly, people's objectives are going to change. And, this is true of every part of our life, right? Whether it be the clothing we buy, the food we buy, and anything else. So from my perspective, I do feel more upbeat there. What I think also gives me a lot of comfort is the fact that just the sheer kind of the innovative nature and the dynamism of this sector as well. I'm old enough to have got in. I started out in conventional finance and quote unquote again, and then moved into sustainable finance. I've been working in this space for about 15 years. When I compare, when I think of where we were 15 years ago versus where we are now, I think there's been an extraordinary amount of innovation, new product structures, new understandings. And I think this, regulation is a logical end point of that as well. So I think we can also, perhaps in some respects, view it as a positive step, that this whole ecosystem, this whole infrastructure is developed, and that now hopefully the tools are there that will enable us to go out there and do the job, basically.
Okay. Yeah, that's the way I felt coming away from the interviews that I did at that conference last week. And so it seems like a lot of firms are moving in positive direction, which is really healthy, I think, for all of us. And Paul, where can followers of the Sustainable Finance podcast go online to learn more about responsAbility AG, and how can they get in touch with you with questions about the topics that we've discussed in today's episode?
Well, I mean, our website, responsAbility.com, has a lot of information on this topic. And I think on the website, there's a contact point where you can reach out and ask us questions. So that can all that will all come to me. Or well, not all of it. Some of it will come to me. But there's plenty on our website about the kind of things that we do, the topics that we cover. There's also plenty about the sectors where we're present as well, and which explains, I think, in a bit more detail, look, why is it important to invest in these sectors? So I would encourage anyone who has questions to look at the website first. If you still have questions, reach out to us via the website, and we're always happy to engage with people on this topic. And I'm more than happy to speak about this topic until the cows come home, basically.
Okay, great. Well, thanks again to Paul Hailey, the head of Impact and ESG at responsAbility Investments AG. And our followers can join us again next week for another episode of the Sustainable Finance Podcast. I'm your host, Paul Ellis.